history of our country. What's the worst it's ever been? Well, the last 2 years of World War II, the highest marginal tax bracket was 94%. And that was for any dollar that you made above and beyond $200,000. Now, $200,000 back then was a pretty big deal. It was about $3.2 million in today's dollars. Can you even think of anybody back then that made that type of money? Well, there was an actor who later became a politician. Can you think of who that was? That's right, Ronald Reagan. If you study Ronald Reagan's biography, he talks about how he never made more than 2 movies in a year. Reason being, he made about $100,000 per movie, and any dollar he made above and beyond $200,000, he only kept 6 cents on the dollar. And truth be told, he didn't even get to keep the 6 cents. Who do you think got the 6 cents? That's right, the state of California, to pay for state tax. So it literally did not make sense for Ronald Reagan to work past the month of June. Well, that was a long time ago. Let's fast forward to the decade of the 70s. What was the worst federal marginal tax bracket you could pay throughout the entire decade of the 70s? Well, easy to remember. Throughout the entire decade of the 70s, the worst federal marginal tax bracket you could pay was 70%. Once again, for any dollar you made above and beyond $200,000. Now let's fast forward to today. What is the worst federal marginal tax bracket you can pay today? The tax rate at which Bill Gates pays taxes on most of his earned income? 37%. So here's my question for you, and this is not a trick question. How does 37% stack up against some of these tax rates we've experienced in the past? You might be thinking low, historically low, and it's interesting you might say that because as I give this workshop all across the country, I routinely ask rooms full of people, how bad are taxes today? And what do you think they say? They say terrible, horrible, as bad as they've ever been. What's the truth? The truth is tax rates today are about as low as we've seen in our lifetime. However, something is going to happen in that tax bracket January 1st, 2026. Is it going to go up or is it going to go down? It's going to go up. What's it going to go up to? 39.6. And folks, in order for that to happen, all Congress has to do is nothing. Is Congress pretty good at doing nothing? Sure. Well, is 39.6 enough to keep me awake at night? Well, 39.6 is what tax rates were throughout the entire decade of the 90s. You guys remember how the stock market was doing in the 90s? Was it doing okay? Yes, it was doing great. In fact, if you dropped $100,000 into the S&P 500 in 1990, took a nap for 9 years, woke up in 1999, what would that 100,000 have been worth? It would have been worth $600,000. So your money would have sextupled during the decade of the 90s alone. And that's under these kind of tax rates. So again, not enough to keep me awake at night. The real question that I have for you today, however, is this: what is likely to happen to tax rates as we move forward in time beyond 2026 to 2028, 2030 and beyond? What does your gut tell you? Are tax rates down the road likely to be higher than 39.6? Or for those of you who say yes, my question for you is why? What will we be spending money on as a country that could literally force tax rates to go up? What are the big ticket items? Well, let's start off with debt. And it's not so much the debt, it's the interest on the debt, the cost of renting the money that we've already spent. Thanks to COVID-19, we just blew past $26 trillion. We're well on our way to $27 trillion of debt. We've got the cost of Medicare. We've got the cost of Medicaid, Social Security, the cost of bailing out the economy due to COVID-19, and the list goes on and on and on. Pensions, this is actually a really good one. The other day I was talking to a lady. I said, hey, what happens to your pension if your company goes broke? She says, don't worry. No matter what happens to my company, the federal government guarantees that I will always receive 2/3 of my pension every year till I die. Folks, that is what we call an unfunded obligation. What's an unfunded obligation? It's a promise the federal government's made that they can't afford to keep. Some economists have suggested that what the federal government has promised that they can't afford to pay is about $120 trillion. However, there's a very famous economist out of Boston University by the name of Dr. Lawrence Kotlikoff. He's the foremost expert in the country on what we call fiscal gap accounting. And what he does with fiscal gap accounting is basically he projects out over 75 years everything that we promised to pay for Social Security, Medicare, Medicaid. He projects out over that same time period what we can actually afford to deliver under today's tax rates. And he says, if there's a difference between those two numbers, you have a fiscal gap. And that fiscal gap is your true national debt. He says the real national debt's not 26 trillion. It's not even 120 trillion. It's much closer to 239 trillion dollars. In other words, we'd have to have $239 trillion sitting in a bank account today, earning treasury rates to deliver on everything that the federal government has promised to pay. And the list goes on and on and on. But if you had to pick two things on this list that will make debt go up more over time than any two other things, which two would you pick? Well, if you said Medicare and Social Security, you would be absolutely correct. Let's see if we can wrap our brains around why. I'm going to open up a brief parenthesis just on Social Security alone. A few more questions for you. When was Social Security first established? When did they roll it out? Well, it was the linchpin of the New Deal. It was a hallmark of the Roosevelt administration. They rolled it out in 1935. And when they first started out, how many workers were putting money into the program for every one person that took money out? What did that ratio look like? Well, it was an astounding 42 to 1. And back then, how old did you have to be before you could touch Social Security? Well, you couldn't touch it until age 65. Well, anybody want to take a stab at what the average life expectancy was back then? Well, it was only 62. They didn't even anticipate that the average person would live long enough to ever draw on Social Security. If you were lucky enough to make it to 65, how long did you draw on Social Security before you tipped over dead? Only a couple of years. So in summary, when Social Security first started out, you had all these people putting money in, hardly anybody taking money out. And when they took it out for 2 years, then they died. Was Social Security pretty solvent when it first started out? You bet it was. And then something happened. Soldiers came home from World War II and they started to do something at a rate at which they'd never done it before. What'd they start doing? That's right, they started to have babies. In fact, if you look at generational trends, demographic trends over the last 100 years, it looks a little bit like this. You start off at the turn of the century with what we call the Henry Ford generation, or as Tom Brokaw called it, the greatest generation. And they were followed up by what we call the silent generation, still sort of reeling from the Great Depression. And then what do we call this big statistical anomaly in the middle here? That's right, these are our baby boomers. It's 25% of our country, 78 million people. And did they have a few children of their own? Sure. Generation X. I am a Generation Xer. And then we had children of our own. What do we call these folks? This is Generation Y. Folks, I've got 7 children. That's exactly what I asked myself in the middle of the night. Little 7-kid humor for you there. Now, as you look at this chart, did baby boomers, these folks in the middle, have nearly as many children as their parents did? No, not even close. In fact, they had almost 30 million fewer children. So if you were to ask yourself today, how many workers are putting money into Social Security for every one person that takes money out, what does that ratio look like today? Well, it's actually much closer to 3 to 1. In another 10 years, what's that going to look like? Closer to 2 to 1. And what's the earliest you can draw on Social Security today? You can actually start drawing as early as age 62. And if you start at 62, how long will you continue to draw on average before you tip over dead? It's like 23 years until age 85. Folks, is Social Security today just a little bit different than when it first started out? You bet it is. It started off as insurance against living too long, and it slowly morphed into a pension program that covers us for nearly a quarter of our lives. If this is significant to you, if this is personally important to you, what I want you to do right now is I want you to go and type SSA into the chat box. Type SSA into the chat box. I'll give you a few seconds to do that. So you may not know exactly what to do with this information right now, but the offer we'll be making at the end of the presentation should help with that. Okay. All right. Very good. Let's keep moving. How many of you guys have ever heard of a guy named David Walker? David Walker. David Walker was what we call the Comptroller General of the U.S. government. What does that mean? That means he was the head of the Government Accountability Office. He was on the board of Social Security. He's basically the CPA of the USA. The reason I tell you, and by the way, he did that for 10 years under Bush and Clinton, so very centrist, nonpartisan sort of a guy. And the reason I tell you this is because David Walker knows more about these numbers than just about anyone else on the planet. And he took one look at the books and he said, hey, we have promised way more than we can afford to deliver. He says, you think Social Security is bad. He says, Medicare is 5 times more expensive. He said to be able to deliver on these 2 promises alone, he said we would have to double taxes immediately. He said you don't have to double taxes immediately, but for every year that you postpone doubling taxes, the national debt will grow by $2 trillion per year, each and every year, until we hit this magical moment in our country when we have $53 trillion of debt. Folks, what's wrong with a country that has $53 trillion of debt? Well, did you know that if we had $53 trillion of debt, that all of the revenue flowing into the U.S. Treasury at that point under today's tax rates would only be enough to pay the interest on all that debt, let alone any principal, let alone a single dollar for Social Security, Medicare, Medicaid, or anything else we listed on that screen. David Walker was so concerned about this that in 2008, he resigned and started to crisscross the country, raising the warning cry to whoever would listen. And in 2010, he wrote a book called Come Back America, in which he sort of diagnosed the problem. And he appeared on NPR to talk about his book. And he told the radio show host this, he said, hey, look, tax rates have to double or we're going to go broke. And she didn't believe him. So he says, look, I can give you one 4-letter word to explain why tax rates have to double. And she couldn't guess what it was. So they opened up the phone lines and people started to call in and nobody could guess what the 4-letter word was to explain why tax rates have to double. We heard debt, that was the number one guess, kids, jobs, fear, wars. One guy even said health. They said, no, it's definitely not that. What is that 4-letter word to explain why tax rates have to double? It's math. Math is a 4-letter word to explain why tax rates have to double. What did David Walker mean by math? Well, basically he said, look, if this is what you're spending and this is what's coming in, you can either double what's coming in, cut in half what's going out, or some combination of the two. I remember I was giving the same presentation 2 days before midterm elections in 2009 in a little city called Fond du Lac, Wisconsin. And when I was done, everyone came up to me at the end and they said, Dave, who should we vote for? Who should we vote for? And I never felt so powerful. And I said, you know what? It doesn't matter who you vote for, because whoever gets elected is going to inherit a math problem, the solution to which involves either doubling taxes, reducing spending by half, or some combination of the two. Well, for those of you who have watched cartoons growing up, you know exactly who this is. It's the Roadrunner. Who's always trying to kill the Roadrunner? That's right. Wile E. Coyote, super genius, right? Well, a couple of years ago, I was watching the Roadrunner, and in this particular episode, the Coyote was trying to kill the Roadrunner, and he was doing a bomb with which he was building a bomb with which to do so. And what company makes his bombs? That's right, Acme. So he's building a bomb made by Acme inside a shed that was also made by Acme. And he was so focused and intent on finishing this bomb that he didn't realize that the Roadrunner had pushed his shed onto the train tracks. Maybe you've seen the episode. And he was so focused and intent on finishing this bomb that he also didn't realize until the last possible moment that there was a huge freight train bearing down on him. Now, very important question, most important question I'm going to ask today. If you found yourselves on a train track with a huge freight train bearing down on you, what would you do? Well, you'd probably jump out of the way. You'd probably haul yourself to safety. Well, let's go back to the Coyote. The Coyote sees this huge freight train bearing down on him. Instead of jumping out of the way, what does he do? He simply pulls down the window shade, thinking that the act of doing so would make the problem go away. Did the problem go away? No, there's a huge explosion. And does the Coyote ever really die? No, it's frustrating, right? But as the smoke and fire cleared away, you could sort of see him limping off screen, very much the worse for wear. Well, folks, why did we gather here today to talk about the Roadrunner? Well, as Americans who save the majority of their retirement savings in what we call tax-deferred vehicles like 401ks and IRAs, we got a very real freight train that's bearing down on us. And it's bearing down on us in the form of what? Well, it's bearing down on us in the form of higher taxes. And we got a couple of choices of what we can do about it. We can pretend like the problem doesn't really exist. We can pretend like the math to which David Walker referred doesn't really add up, but isn't that a little bit like pulling down the window shade? Or we can implement some strategies starting this year that can help remove us from the train tracks, thereby insulating and buffering us from the impact of higher taxes. So what we're going to do in the balance over time is we're going to talk about some of those strategies that you can implement right now to help insulate yourself from the impact of higher taxes. Well, as you know, there are lots of different ways to save money for retirement. In fact, there's millions of different types of investments out there, but I'm here to tell you that no matter where you save your money for retirement, all of those investments basically fit into only 3 types of accounts. 3 basic types of accounts within which to save money for retirement. Today, we're going to talk about these accounts in terms of buckets of money. The first bucket we're going to talk about is what we call the taxable bucket, meaning every year as your money grows, you get to pay a tax. What are some common examples? All things you've heard of before: savings accounts, CDs, money markets, stocks, bonds, mutual funds. You guys get the idea. Now, how can you tell if you have a taxable investment? Well, every year at the end of the year, the financial institution sends you that little love letter. It's called a 1099. It says, hey, your money grew this much. Now you got to give a portion of that growth back to the IRS in the form of taxes. So the 1099 is the tip-off. So generally speaking, the growth on the money in this bucket is 100% taxable. If that's the case, why do we even have these types of investments? We have them because generally speaking, they're very liquid, which means that they make for great emergency funds. What do financial experts tell us about how much money we should have in emergency funds? What have you heard? That's like the one number they can actually agree upon: 6 months worth of basic living expenses. Having said that, can you have too much money in this bucket? Yes, and we see it all the time. So the moral of the story here is that you can have too much money in this bucket from a tax efficiency perspective, but not enough from an emergency fund perspective. What we're looking for in this bucket is just the right amount. And just the right amount is, that's right, 6 months worth of basic living expenses. Second bucket is what we call the tax deferred bucket, meaning you don't pay tax as your money grows. When do you pay the tax? At the very end, when you take the money out. What are some common examples? 401ks, IRAs, 403bs, SEPs, simples, annuities. You guys get the idea. Now, there's all sorts of different rules that apply to these investments, but generally speaking, they all have 2 things in common. The first thing they have in common, generally speaking, is when you put money in, you get a tax deduction. So for example, if you make $100,000 per year and you put $10,000 into your 401k, what's your new adjusted gross income? That's right, $90,000. The second thing they have in common is the manner in which they're taxed upon distribution. Now, the IRS has a special word that they use to characterize this income when you take it out. What do they call this income when you take it out? They call it ordinary income. Ordinary income. So what does that mean? That means that when you put money into your 401k, all you really did was defer the receipt of that income until some point much further down the road. And when you take the money out, at what rate are you taxed? At whatever tax rates happen to be in the year you take that money out. So folks, isn't that a little bit like going into a business partnership with the IRS? And every year the IRS gets a vote on what percentage of your profits they get to keep. Does that sound like a good business partnership to anyone? So you could have $1 million in your IRA or 401k, but unless you can accurately predict what tax rates are going to be in the year you take that money out, do you really know how much money you have? No. And is it hard to plan for retirement if you don't know how much money you have? Absolutely. Well, let's talk about a third bucket. A third bucket has all sorts of different names. Some people call it tax advantage, some call it tax preferred, some call it tax exempt. I like to call it tax free. Now, I got to warn you, there's all sorts of different investments out there that masquerade as tax free, but I'm here to tell you, to be truly tax free, it's got to qualify in 2 different ways. The first way is it's got to really be tax free. And when I say tax free, I'm talking free from 3 different types of taxes: free from federal tax, free from state tax, and free from capital gains tax. Well, How many of you guys have heard of municipal bonds? Well, we've been told for years and years and years that municipal bonds are tax-free. Well, let's take a look at it. Are municipal bonds free from federal tax? Well, they actually are free from federal tax, but are they free from state tax? Not necessarily. For example, if I live in Wisconsin and I buy a municipal bond from Illinois, would the state of Wisconsin give me a tax break for that? No, because I'm not benefiting the state in which I live, the municipality in which I live. And let's say I don't want to put all my eggs in one basket. So I buy a mutual fund of municipal bonds, and that mutual fund appreciates in value and I sell it at a gain. Will I pay capital gains tax? You bet I will. So an investment that we've been told for years and years and years is tax-free doesn't meet our first basic test. The second thing I'm looking for in a true tax-free investment is that when you take distributions, it should not count as provisional income. It should not count against the thresholds which cause Social Security taxation. How many of you guys have heard of the phrase provisional income? If you haven't heard of it, don't feel badly. I gave the same talk to 100 CPAs a couple of years ago. I said, how many of you guys have heard of provisional income? How many hands do you think went up? Only two. Only two of the CPAs recognized the phrase provisional income, which is scary because what's provisional income? That's the income the IRS tracks to determine, once again, to determine if they're going to tax your Social Security. And what they do is they say, hey, look, any 1099s out of your taxable bucket count as provisional income, any distributions at all from your tax deferred bucket count as provisional income, and 1/2 of your Social Security counts as provisional income, and they add all this provisional income up. And if as a single person, it adds up to more than $34,000, or if as a married couple, it adds up to more than $44,000, then up to 85% of your Social Security can become taxable to you at your highest marginal tax bracket. Let me put that into perspective for you. Let's say because of your levels of provisional income, you have a $5,000 hole in your Social Security because of Social Security taxation. How do you think most Americans go about plugging that hole? That's right, by taking more money out of their IRA or 401k. So here's a math question for you. If tax rates went up to 50%, like David Walker's predicting, how much money would you have to take out of your IRA to be able to pay that 50% tax of the IRS and then be left over with $5,000 with which you can then plug the hole in your Social Security? That's right. What's double 5,000? It's $10,000. Folks, why do I even bring this stuff up? I bring it up because I've done the math 100 times in 100 different ways and 100 different clients. And this is what I've concluded. I have concluded that when your Social Security gets taxed, you run out of money 5 to 7 years faster than people who do not have their Social Security taxed. Why? Because the act of compensating for Social Security taxation forces you to spend down all your other assets that much faster. By the way, when you take interest off your municipal bonds, does that count as provisional income? You bet it does. So an investment that we've been told for years and years and years is tax-free doesn't meet either of our basic tests. So folks, if this is personally important to you, what I'd like you to do right now is to simply type buckets right into your chat box. Take a couple of seconds to do that. And again, for some of you, this may be eye-opening stuff and you're not sure what you're supposed to do about it, but the offer we'll be making later will help with that. Okay, great. Thank you, folks. Now, what I'd like to do with the balance of our time is I'd simply like to give you a little case study, a little scenario. Now, the one thing I can guarantee is that this scenario will not fit any of you on this webinar perfectly, but I can guarantee that there will be something in this example that does apply specifically to your situation. So I want you to watch out for it. So what we have here is Mr. and Mrs. Jones, obviously a very happy couple. They're 50 years old. They want to retire in 15 years, and they make about $100,000 per year. Now remember, we've got our 3 buckets. What are the names of our 3 buckets again? That's right, taxable, tax deferred, and tax-free. Now let's say that Mr. and Mrs. Jones have $500,000 sitting in their IRA in the tax deferred bucket. They've got $100,000 in some plain old taxable mutual funds. That's their emergency fund. They're putting 10% into their 401k. They're getting no match, no employer match, no free money. And they're paying $2,000 per year for some term life insurance and $4,000 per year for some long-term care insurance. Now, if someone like this walked into a traditional tax-deferred financial advisor's office, how would the conversation go? Well, it just so happens I've been training traditional tax-deferred financial advisors for the last 17 years of my life. And in the act of doing so, I have sat in their offices and I've listened to them as they've spoken to people like this for the very first time. And here's how the conversation goes. Mr. and Mrs. Jones, congratulations. They always congratulate you. You've done a great job saving money in this IRA. Problem is, last year down the road when you were at XYZ company, you only earned 7%. We think we can get you 8%. So roll all that money over to us. As far as your mutual funds go, that's a great emergency fund. Problem is, last year down the road, you only earned 3%. We think we can get you 5%. So let us manage that for you as well. As far as your 401k with no match goes, keep on doing it. When you switch jobs, give me a call. We'll roll your 401k into your IRA, get everything under one roof, maybe save you some break points, save you some fees. And as far as your term life insurance and long-term care insurance goes, gosh, you know, not really what we do. So who are we to say you shouldn't keep doing it? And that's a conversation I've heard literally dozens and dozens of times. Well, when someone like this walks into my office for the very first time, I see red flags all over the place. For example, I'm not so much concerned with what's in this IRA today. What keeps me awake at night is what this IRA is going to be worth 15 years from now if it grows at 8% per year. What's it going to be worth 15 years from now if it grows at 8% per year? Much closer to 1.6 million. Folks, I know this sounds great, but what's wrong with having 1.6 million in your tax deferred bucket? Well, did you know that if you had 1.6 million in your tax deferred bucket, that required minimum distributions alone would put you in one of the higher marginal federal tax brackets and literally guarantee that your Social Security would be taxed in perpetuity with all of the compensating spend down that goes along with that? So what we want to do is we want to prevent this IRA from ever getting to 1.6 million. So here's my question for you folks. How do you prevent an IRA from growing? And don't anyone say, put it in the stock market. Well, one of my very favorite ways of preventing an IRA from growing is by doing what we call a Roth conversion. Now, Roth conversion simply says that if you have money in your tax deferred bucket in the form of an IRA, you can shift it to tax-free so long as you pay what along the way? So long as you pay taxes at what rates, at whatever the rates happen to be in the year you do the conversion. So let's say that Mr. and Mrs. Jones convert all 500,000 all in 1 year. They pay 40% tax. How much tax are they going to owe? What is the size of their tax bill? Well, it's $200,000. Well, here's the problem. Do Mr. and Mrs. Jones have $200,000 just lying around that they can earmark for this tax bill? No, they don't have it. So some people say, hey, that's okay. They don't need to have it. Just have the IRS withhold the tax right out of the IRA itself. Folks, what would happen if they paid the taxes on their Roth conversion as a couple of 50-year-olds right out of the IRA itself? Well, they get a 10% penalty. The IRS says, even if you pay the tax, take the tax out and you give it right back to the IRS in the next breath, if you're younger than 59 and a half, they will give you a 10% penalty for doing so. So folks, here's a rule of thumb. Unless you've got a lot of money just languishing in your taxable bucket that you would happily earmark for a tax on that Roth conversion, I would probably suggest that you wait until 59 and a half before you start considering Roth conversion. So the question becomes, is there any other way to get money out of that IRA pre-59 and a half without penalty? Well, at this point, I may bring up that little known section of the IRS tax code. It's section 72, subsection T. In our industry, we call it a 72T. And a 72T says that you can take money out of your IRA pre-59 and a half without penalty, so long as you do it in separate, equal, yearly distributions that last for at least 5 years or until 59 and a half, whichever is longer. These days, by way of a 72T, a couple of 50-year-olds could take out about 5% per year. So we take 5% out by way of that 72T, and that means that they can shift $25,000 per year to their tax-free bucket. All right, let's take a look at these mutual funds. If that's their emergency fund, how do we feel about it? Do they have too much or too little in their emergency fund? Well, if they make $100,000 per year, they should probably have much closer to 50,000. So not only do they have too much, but they're growing into mutual funds, which means the problem in theory is getting bigger every year. So what we want to do is we want to take the growth on that mutual fund, plus some of the principal, and we want to reposition it from taxable to tax-free little by little, year by year, such that by the time they reach retirement, they've got the perfect balance. And folks, I've done the math on this. That would require an annual shift from taxable to tax-free of $6,000 per year. All right, how do we feel about 401ks that don't have matches? Folks, this is the one thing that Susie Orman, Dave Ramsey, and Clark Howard actually agree upon. The rule of thumb when it comes to 401ks is you put in up to the match, but not one penny above and beyond. You do whatever's required to get the free money, and then you move on to the next best option. Well, if these folks are trying to prevent their IRA from growing by doing a 72T, yet they're putting money hand over fist into their 401k and they're getting no free money, are those two strategies at odds with each other? You bet they are. So what we want to do is we want to recapture that 10%, which is $10,000. We want to reposition it tax-free. And how do we feel about term life insurance and long-term care insurance? We feel like it's incredibly important to mitigate both of these risks. We feel like just sometimes there's a better way to accomplish it. So we may recapture that $6,000 as well. So all told, we freed up $47,000 to be able to reposition to tax-free each and every year. And usually at this point, someone will say, hey, Dave, not so fast. You don't really have 47,000 freed up. And I'll say, why not? And they'll say, because some of those recommendations that you made are actually taxable events. And you know what? They're right. That 72T is a taxable event. And when you put less money into your 401k, that can increase your taxable income. So that's also a taxable event. So because of this strategy, we just realized $35,000 of additional taxable income. Let's call it 30% tax on the margin. That's $10,500 of additional taxation every year that we do this strategy. So here's the question, folks. Do Mr. and Mrs. Jones have $10,500 just lying around that they would love to earmark for this tax bill? Not that they would love. And if we say, quit going out to eat, quit going on vacation, pull back the belt a couple of notches just so you can pay that tax bill, will they return my phone calls? Probably not. So we got to find a way to help them pay that tax bill such that we are not encroaching on their lifestyle. So what I may simply recommend is that they pay that tax bill right out of the $47,000 that we just freed up, which means we really have $36,500 to be able to reposition to tax-free each and every year. So folks, this is where the rubber hits the road. Where can we put $36,500 per year such that it grows in a truly tax-free way? Well, at this point, I'm going to recommend that they fully fund one of my very favorite tax-free investments, and that's what we call a Roth IRA. How much money can two 50-year-olds put into Roth IRAs these days? $7,000 each, for a total of $14,000 per year. Folks, why do I like Roth IRAs so much? I like them so much because Roth IRAs are truly tax-free. So long as you're 59 and a half when you take the money out, you don't pay any of those taxes we talked about. And when you take money out of your Roth IRA, it does not count as provisional income. It does not count against the thresholds which cause Social Security taxation. When I say Roth IRAs, I'm talking any investment with the word Roth in front of it. It could be a Roth IRA, Roth 401k, Roth conversion. They are all truly tax-free. So what we'll do is we'll take that $14,000 from the original $36,500 that we freed up on that previous screen, and that leaves us with $22,500 per year to be able to reposition to tax-free. So that begs the question, where do we put $22,500 per year such that it grows in a truly tax-free way? Well, at this point, I may bring up a bucket of money that gets treated differently for tax purposes than anything else we've talked about so far. And what happens with this bucket is you put money in. As your money grows, your bucket begins to fill. Only the IRS says that the growth on the money in this bucket is going to be treated under a different section of the IRS tax code than anything else we've talked about so far. What does that section of the IRS tax code say? It says that you can touch this money pre-59 and a half without penalty. Can you do that on your IRA or 401k? No, you cannot. They're going to tell you that as your money grows, you receive no 1099s. What does that mean? That means no tax as your money grows. They're also going to tell you that when you take the money out, if you take it out the right way, it does not show up as reportable income on your tax return, and it also does not count as provisional income. They're also going to tell you that there are no contribution limits. You remember what we said were the contribution limits for the Roth IRA, $7,000 each for a total of $14,000 per year. Well, guess what? I've got clients who do $50 a month, and I've got clients who do $200,000 per year, and everywhere in between. There are no limits on how much you can put into this bucket. They're also going to tell you that there are no income limitations. Let me ask you a question. Can Bill Gates do a Roth IRA? The answer is no, he cannot. Why? He makes too much money. You start making north of $206,000 of modified adjusted gross income, you can no longer do a Roth IRA. That rule does not apply to this particular bucket. They're also going to tell you that if history serves as a model, there may be no legislative risk. What does that mean? That simply means that should somewhere down the road they change the rules on this bucket, they simply say, hey, whoever has the bucket before the rule changes gets to keep it and continue to put money into it under the old rule for the rest of their lives. We call that a grandfather clause. Well, usually right about now, people are saying, well, gosh, Dave, this is like the perfect investment. This is like the alignment of the stars. Why not just put all my money into here? Well, first of all, is it ever a good idea to put all your eggs into any one basket? The answer is, of course not. Not only that, but the IRS says if they're going to give you the benefit of an unlimited bucket of tax-free dollars, they're going to require that there be a cost of admission. They're going to require that there be a spigot attached to the side of this bucket through which flows on a monthly basis some expenses. And what do those expenses go towards? They go towards some administrative fees, but they primarily go towards the cost of term insurance. Now, let me ask you a question. If your house is paid off, your kids have moved out, you're rapidly approaching retirement, is term life insurance really all that high on your wish list? The answer is no. It's usually right about now that people start dumping their term life insurance. And the companies that sponsor these programs recognize that, so they've done something to sweeten the pot. They simply say that in the event that somewhere down the road you should need long-term care, they will give you your death benefit while you're alive for the purpose of paying for it. Here's an example. Let's say you got a death benefit of $400,000. You wake up one day, you can no longer feed yourself, bathe yourself, transfer yourself, what have you, any 2 of 6 activities of daily living. You can find one doctor to write one letter to that effect. They will start sending you 25% of that death benefit, or $100,000 per year every year for 4 years for the purpose of paying for long-term care. Now, they may discount that $100,000 number slightly based on your age in which you elect the benefit, but the point is this: they're willing to give you your death benefit while you're alive for the purpose of paying for long-term care. Well, how many of you guys have looked into traditional long-term care insurance? Well, first of all, is it expensive? Yes, it's getting more and more expensive all the time. Number 2, can it be hard to qualify? Sure, you may live to be 120, but you got a bad back, a bad hip, a bad knee, you may not even get accepted. And what happens if you pay for 30 years and die peaceful in your sleep, never having used it? Do they send you all your money back at the end? The answer is no. It goes to pay for someone else's benefit. And that can be a source of heartburn for a lot of different people. Why is this different? This is different because if you die peacefully in your sleep 30 years from now, never having needed long-term care, guess what? Someone's still getting a death benefit, probably your kids. So there isn't that sensation of having paid for something you never have to use. By the way, have Mr. and Mrs. Jones here already bought off on the idea that they need term insurance and long-term care insurance? Sure, they've already budgeted for it. All we're suggesting is, instead of sending that off to an insurance company in the form of a premium payment, why not recapture it, dump it into their bucket, let just a portion of it drip out in the form of expenses, and now take advantage of a huge bucket of tax-free dollars that wasn't previously available to them. By the way, what do we call this bucket? We call it the LIRP. What does that stand for? Life Insurance Retirement Plans, Chapter 5 of my book, The Power of Zero. Why life insurance? Because the IRS says in order for this bucket to work, you gotta be willing to pay for some life insurance. You gotta have a need for life insurance. Why retirement plan? Because one of the ancillary goals of this bucket is to build money up so that somewhere down the road you can take money out and spend it on your retirement at a period in time when tax rates are likely to be dramatically higher than they are today. All right, before we go any further, I've got a very, very important question to ask. Is simply this: if you could be in any tax bracket of your choosing in retirement, which tax bracket would you choose? Well, if you know the name of my book, you know that my very favorite tax bracket is the 0% tax bracket. Well, if what Mr. and Mrs. Jones want is to be in the 0% tax bracket, tell me how we're doing so far. They're going to have money coming out of their Roth IRA so long as they're 59 and a half when they take that money out. Will they pay tax? No tax. They're going to have quite a bit of money coming out of their LIRP regardless of how old they are when they take the money out. Will they pay tax? No tax. Now, let's go back to that IRA. Remember that IRA? Our goal in doing the 72T was simply to prevent that IRA from getting any bigger. Well, if we did a good job of preventing that IRA from getting any bigger, how much money should they still have in that IRA by the time they reach 65? That's right, $500,000. So here's my question for you. If at age 65 they have $500,000 in that IRA, is there any way for them to take money out of that IRA, spend it on their lifestyle, not pay tax, and it's got to be legal? Well, remember, if you retire today, absent any other deductions, the IRS gives you a deduction. What do we call that? We call it a standard deduction, which if as a married couple you retire today would be $24,800. Well, guess what? The IRS indexes that number to keep up with inflation. So by the time they retire at 65, they're going to have much closer to $38,800 of deduction. So here's the question. If at age 65, they have $500,000 in that IRA, how much money could they take out of that IRA without paying any taxes at all? That's right, $38,800. What's the moral of the story here, folks? So long as you only take out up to whatever your standard deduction happens to be in any given year, you now have an IRA that's 100% tax-free. By the way, if we have no tax, and no tax, what do you suppose, and we can stay below our provisional income thresholds, what do you suppose happens to their Social Security? That's right, no tax. And if we have no tax, what tax bracket does that put us in? That's right, the 0% tax bracket. And folks, why do I make such a big deal about being in the 0% tax bracket? Well, if we can't get you to the 0% tax bracket, what's the next best tax bracket? And don't anyone say 1? That's right, it goes all the way up to 10, throw in another 6% for state. Now we're talking 16, and if what David Walker says comes true and tax rates have to double to keep our country solvent, now we're talking 32. And all of a sudden, second place isn't looking all that great. Now, I love it when things make sense conceptually, but I love it even more when things make sense mathematically. So what I did for Mr. and Mrs. Jones here is I did what's called a before and after comparison. What I did is I simply said, hey, if Mr. and Mrs. Jones had never met me and they kept on doing exactly what they were doing in Texas somehow, some way, managed to stay at 30% for the rest of their lives, how much money would they be able to spend after tax? Well, according to my math, they'd be able to spend just shy of $4.4 million. And I know what you're thinking, that sounds like a lot of money. Well, it is a lot of money. The problem is they run out of money at age 85, at which point they can either die or move in with their kids. Conversely, if they do everything that we talked about in this case study, we get them to the 0% tax bracket, we get their Social Security tax-free. They never run out of money. They spend almost $8 million. They still have $1.4 million left over at the end. People say, hey, Dave, how could there possibly be such a huge difference between these two scenarios? And I say, when you make tiny strategic changes midway through your life and you amortize those changes out over the balance of your retirement, there can be a massive quantum difference on the back end. Now, more importantly, what happens to the blue column if tax rates double? Does it get bigger or smaller? That's right, it gets smaller. And what happens to the gray column if tax rates double? It stays exactly the same. Why? Because if you're in the 0% tax bracket and tax rates double, 2 times 0 is still 0. Folks, that is what we call the power of 0. So for those of you who think this is a meaningful concept and getting to the 0% tax bracket could positively impact your retirement, what I want you to do is go ahead and type 0 into your chat box right now. By this time, you may be starting to see the big picture, and the offer we'll have for you in just a few minutes will help bring that into focus. Thank you for that. Now, usually at this point, we get a couple of different questions. And by the way, the number one question that we get, far and away, the number one question that we get is, hey, Dave, am I too old to get to the 0% tax bracket? And I usually respond to that question in the following way. Throughout 2018, filmmaker Doug Orchard and I crisscrossed the nation, interviewing all of the most important experts in the country on the national debt as it relates to the future of tax rates. Take a listen to what they had to say.
The truth is the federal government has lost control of the budget.
Instead of paying for all the new initiatives, whether they're tax cuts, spending increases, all sorts of things that we like, the government's just putting it all on the national credit card. And as a result, our national debt is just going up and up and up. And it's growing faster than the economy. And that's when you know you have a real problem.
Everything is going to be squeezed out of the budget. There won't be anything left.
The road we're on is a perilous one that ultimately leads to the bankrupting of our country.
So we have a crisis on our hands.
All Congress has to do for this whole situation to come to a head is nothing. Because every year that they do nothing makes the problem even more unsolvable.
We don't seem to have the ability to get along and find common ground.
Is the government trying to trick you right now? And the answer is very simply yes.
So why is this being swept under the rug? Why is nobody talking about this?
Probably because it's not popular.
So I've actually been traveling around the country for about 4 years now, taking the Power of Zero message to different groups.
When you cut taxes on current generations, you are simultaneously raising them on future generations.
It is all driven by spending. Once we have spent a dollar, we've already decided to tax it. The only question is whether we tax it now or we borrow it now and tax it in the future.
So to make up for the liabilities that we're incurring with all the promises we've made in social insurance programs, we're going to have to increase substantially the tax rate and perhaps even double it.
Now, precisely how high it's going to be, there's a lot of room to debate, but people will have to pay more taxes.
People's retirement savings are at risk of future higher taxes.
Well, qualified plans really do two things. They defer the tax and the tax calculation. Now let that run past your brain real slow.
I'm driven by trying to help as many people as I can avoid this disaster that's going to come up in retirement when taxes go up and the market goes down. What are these people going to do if they haven't planned ahead of time?
So all these experts are reading the same music and they're singing the same song. They're simply saying that if we don't change course right now as a country, that tax rates even 10 years from now will have to be dramatically higher than they are today. Some of these experts even used the D word as it relates to the future of tax rates. Tax rates will have to double or we go broke as a country. So the real question should not be, are you too old to get to the 0% tax bracket? The real question should be, if 2030 rolls around and tax rates double, will you look back at the year 2020 and say, why did I not take advantage of tax rates while they were historically low? The second question I get is they'll say, hey, Dave, can you be in the 0% tax bracket and still be a good person? After all, if we're all in the 0% tax bracket, who's going to pay for the roads? Who's going to pay for the schools? Who's going to pay for the social programs? Well, first of all, are we suggesting that Mr. and Mrs. Jones here not pay tax? No, we're simply suggesting that when given the choice between paying taxes at today's historically low tax rates or postponing the payment of those taxes till some point much further down the road, you're probably better off paying them today. And finally, hey, Dave, how come I've never heard of this before? Well, I would submit that you guys have heard of just about everything we've talked about today. Maybe not quite in this combination, but you guys have heard just about everything we've talked about today. The only thing that's new for some people is this idea of the LIRP. The only thing that we're doing with the LIRP is the opposite of what most people do when it comes to life insurance. What do most people do when it comes to life insurance? They get as much death benefit as they can for as little money as possible. What do we call that? We call that term insurance. Well, here we're doing just the opposite. We're getting as little death benefit as the IRS requires of us, and we're stuffing as much money into it as the IRS allows in an attempt to mimic all of the tax-free benefits of the Roth IRA without any of the limitations. Well, Why else haven't you heard about this? Well, you got to ask yourself how most major money management institutions make money. How do most major money management institutions make money? They charge you a fee. What's a typical fee? Let's just call it 1%. So let's say that they're managing $1 million of your dollars in the tax deferred bucket and they're charging you 1% per year. How much are they making off you per year? $10,000. No big deal. This is how a lot of financial advisors make money. But here's the rub. If they were to persuade you that tax rates in the future are likely to be dramatically higher than they are today, then you might just feel impressed to shift that money to tax-free. And if you shift it to tax-free, what are you going to have to pay along the way? That's right, taxes. Let's call it 30%. So you pay 30% tax. Now you got $700,000 sitting in your tax-free bucket. If they're still charging you 1%, how much are they making off you per year now? Only $7,000. Well, didn't they just experience a pay cut for persuading you that tax rates in the future are likely to be dramatically higher than they are today? And for that reason alone, most major money management institutions don't want to touch this conversation with a 10-foot pole. In fact, they forbid their advisors from even bringing it up. Me personally, I don't care how much money you have. The only thing that matters to me is how much you actually get to spend after tax. That's the only number that really matters. All right, for those of you who are taking notes, I got a couple of takeaways for you. Takeaway number 1, tax rates in the future are likely to be dramatically higher than they are today. Mathematically speaking, we have passed the point of no return. Takeaway number 2, the only way to truly insulate yourself from the impact of higher taxes is to get to the 0% tax bracket. Why? Because if you're in the 0% tax bracket and tax rates double, 2 times 0 is still 0. Takeaway number 3, folks, I've been doing this for over 20 years. I've helped put thousands of people on the road to the 0% tax bracket, and I've noticed something very interesting. It is nearly impossible to get to the 0% tax bracket by relying on just one stream of tax-free income. For example, it's nearly impossible to get to the 0% tax bracket by just contributing to a Roth IRA. You can't get to the 0% tax bracket by just owning an LIRP. To get to the 0% tax bracket typically requires between 4 and 6 different streams of tax-free income, none of which show up on the IRS's radar, but all of which contribute to you being in the 0% tax bracket. Takeaway number 4, as of January 1st, 2018, tax rates went on sale. But here's the rub. That tax sale has an expiration date of January 1st, 2026. What does that mean? That means that every year between now and 2026 represents a little mini window of opportunity within which to take advantage of historically low tax rates. And every year that goes by where you fail to take advantage of historically low tax rates is potentially a year beyond 2026 when you could be forced to pay the highest tax rates you're likely to see in your lifetime. Takeaway number 5, all of this is really, really good news for you. Let me illustrate with a story. A couple of months ago, it's the early part of 2020, a lady came up to me at the end of my presentation. She said, "Hey, Dave, thanks a lot. Now I'm in a really bad mood." And I said, "Now, why would you be in such a bad mood?" And she says, "Because I got all my money in the tax deferred bucket." And I said, "Well, let me get this straight. You contributed all that money to your tax deferred bucket at a period in time when tax rates were dramatically higher than they are today. You got a deduction at those higher rates for doing so. You now have a 6-year period of time to get those tax deferred assets systematically repositioned to tax free so that by the time tax rates potentially double over time, you've done all the heavy lifting and you can then take that money out tax free." I said, "Is that why you're in such a bad mood?" And she says, "Well, gosh, Dave, I never really thought about it that way." So folks, my question for you is, how is this story going to end for you? Well, I would submit that so long as you take advantage of the next 6 years of historically low tax rates, that you get to determine how much of your hard-earned retirement savings that you